Hello, everyone, and welcome to this HEC Paris virtual conference room for our HEC Insights webinar series. When joining the conference, you will notice that your microphones have been switched off. You will, however, be able to ask questions and make comments using the Q&A menu that you will find at the bottom of your window in the Zoom toolbar. The professors will only answer questions and read comments sent through the Q&A menu and will not be taking any questions coming from the chat.
Ladies and gentlemen, a warm welcome and thank you very much for being with us today. I am Anne Michaud, Associate Dean for Pedagogy at HEC Paris, and it is my greatest pleasure to welcome my colleague Christophe Spaenjers, Associate Professor of Finance at HEC Paris, to talk about beliefs and facts about risk and return in real estate. Christophe is an academic expert on the investment characteristics of real estate, art, and other alternative asset classes. Christophe, thank you very much for accepting the invitation to speak in this webinar. A warm welcome to you, and the floor is yours.
Okay, thank you, Anne. So thanks everybody for being here. So my talk is called Beliefs and Facts about Risk and Return in Real Estate. And so this is exactly what I'm going to talk about. So Anne already said a few words about who I am. So I'm an associate professor of finance, meaning that I'm a research professor at the finance department. I've been at HEC since 2011. As Anne said, my research interests are mainly in alternative investments, so real estate, art, private equity. But I'm also interested in household finance or household financial decision-making, financial history, and this will come back, right? So we'll see how this plays a role in what I'm doing and plays a role in today's talk. Published quite extensively in academic journals. Some of my research has also been mentioned in the popular press. So if you're interested in this, you can always go to my webpage. I have some links there to articles and also to press articles about my research. And I'm also giving you my email address here and my Twitter account in case you want to follow me on social media. Okay, so what am I going to talk about today? I'm going to talk about real estate. Now, when I say real estate, what I'm going to talk about today is mainly residential real estate or housing, right? This is what is really what we think about when we say real estate. This is what most households or what most families or most retail investors are mostly interested in. I just want to point out at the start that for institutional investors, for larger investors, actually they will be more interested in other types of real estate that I will not cover so extensively today. So for institutional investors, actually they may be more interested in agricultural real estate or in particular commercial real estate. Think about offices, shops, apartment buildings, and so on. Or infrastructure projects like transportation, power, infrastructure, and so on. The main focus of today's talk is going to be about households investing in residential real estate or in housing. To set the stage, what I want to do is I want to sort of illustrate how important real estate is in household portfolios. And to do this, what I can do is I can show you composition of household balance sheets. We're a business school after all, so we think about balance sheets. So I'm going to present you what are households, how is households' wealth typically built up, or how is a household's net worth typically built up. We can think of a household's wealth as a difference between assets and debt. What do we mean with assets for a household? Well, if you're a household, you may have an investment in a house or a home. Right? So housing is an important asset, and that's going to be the focus of today's talk. But you may have other non-financial assets like cars or maybe artworks or furniture. And then, of course, there's financial assets like stocks, private business wealth, and so on. And there may be more liquid other financial assets like savings accounts, cash, bonds. Right? So these are all the assets that a household can have. And then, of course, many households also have debt. Think about housing debt or mortgages, which are, again, going to be important. And think about non-housing debt, think about all other types of loans like credit card debt, car loans, student loans, and so on. Right. So if you think about a household balance sheet, you can really think about assets and debt, and a household's wealth, net wealth, is determined by the difference between the two. Now, how is a typical household's balance sheet constructed? So I'm going to show you a picture. I'm going to explain how this. Works. So this is for evidence for the US for all households, aggregating all households starting after World War II. And so above the horizontal axis, above the zero line, you see all the assets, and below you see the debt, right? So again, this is aggregating over all US households. What you see is that household assets are constructed of, or are comprising housing and other non-financial assets. This is the light blue here, stocks and equity in private businesses. This is the darker blue. And then you have bonds, cash, savings accounts, this sort of grayish blue here, right? So you can see on the asset side that housing and non-financial assets are really important for households, right? They typically have as much wealth invested in housing than in stocks or other financial assets. On the debt side, of course, housing debt is really important too, right? And so the difference between the assets and the debt gives you this red line here, which is households' net worth, how households' net worth has changed over time on average or in the aggregate, right? So this shows you how important the housing is for a typical household. It's about as important as stocks or bonds. Now, this is aggregating over all households, and a lot of the dynamics here will be driven by the top 1% or top 5% in terms of the wealth distribution. If we're going to look at a decomposition based on different types of classes, let's say, or wealth classes or categories, what you can see is that housing is even more important for middle-class households or people that are in the bottom 50% of the wealth distribution. So, for example, you can see here on the right-hand side, you can see that for households that we would typically consider middle class, housing is by far the most important part of their balance sheet, right? So again, the light blue line, that's really taking up most of the graph, suggesting that housing is what is determining the wealth, the gross wealth, but also the net wealth of households, much more than stocks and bonds. If you look at the left-hand side, you see the bottom 50%, so the lowest half of households in terms of wealth. You see that it's almost all housing on the asset side and almost all housing debt on the debt side, right? So this is a well-known finding, but if you think about sort of the lower half of the wealth distribution in most countries, households, people don't invest too much in stocks or private equity or bonds. They really have a bit of savings and a lot of housing debt. Right, so these graphs show you how important housing is for the wealth, or how important housing is in the wealth composition of most households. This is evidence from the US, but you can look at other countries as well. So this is evidence from Sweden, from a recent paper. So what this graph shows you is the composition of gross wealth for different groups of households, depending on how wealthy they are. So on the left-hand side, this is the bottom 10% in terms of wealth. Then you have the next 10%. And the more you go to the right in this picture, the more we're going to very wealthy individuals. So very wealthy individuals at the right-hand side here, they have a lot of money invested in things like private equity, stocks or risky financial wealth, commercial real estate. But if you look at the middle class, if you look at everybody, let's say between percentile 30 and 90 or 30 and 95, what's really important is this light blue color, which is residential real estate. For middle-class households, even more than pension wealth or cash or savings, what really matters for their wealth, or what is really the most important part of their wealth, is housing, it's residential real estate. Right, so these pictures are supposed to convince you that housing is the most important asset that most people have. So real estate is by far the most important asset class for middle class households, in particular in economies or countries where home ownership rates are high. And leverage, because most people have a leveraged investment in real estate because they have a mortgage, this of course will amplify returns. Right? So a lot of households, a lot of homeowners are very much exposed to changes in the real estate market because of this leverage. If house prices go up or down by 1% tomorrow, this will translate into a change in wealth of more than 1% up or down for most households, because they have this loan that needs to be paid off. They have this mortgage that is amplifying returns. So what comes out of all this recent research on the composition of households' balance sheets is that how high real estate returns are, in particular compared to stocks or private equity, is really crucial for the dynamics of wealth inequality as well, right? So there's been a lot of debate recently about wealth inequality and the top 1% versus others. But if you really want to think about the gap in wealth between the top 1% or 5% and the middle class, then it's really important what real estate does as an investment, right? The real estate returns will be really crucial for determining whether wealth inequality goes up or down. But so what are the average returns? What is the investment performance associated with housing, right? So what are the average returns or risks associated with home ownership? And so that's what I'm going to go into in the remainder of this talk. And I thought that to start this off, it would be nice to maybe start with a poll. I'm going to soon launch a poll. In 2 minutes, I'm going to launch a poll that will ask you 4 questions. So I'd like you to answer these 4 questions. You don't have to think too deeply, just follow your gut feeling. So I'm going to ask you 4 questions. I'm first going to give you the 4 questions and then I'll launch the poll. So the first question that you'll see is, in general, do you think that this is a good time to buy a house? Right? There's a very good time, somewhat good time, somewhat bad time, or very bad time. Second question, during the next 12 months, do you think that home prices in general will go up or down? Right? In general, irrespective of where you are. Again, follow your gut feeling. What is your first reaction? Questions 3 and 4. In general, do you think that buying a home is a safe investment with a lot of potential, safe with very little potential, risky with very little potential, or risky with a lot of potential? And then question 4 asks the same question for stocks. Okay. So what I want to do now is I'm going to launch this poll. And I'd like you to take a minute to answer these 4 questions. So you need to scroll. So answer the 4 questions, scroll to the bottom, and then give me your responses. And then in 1 minute, I'll review with everyone to see what the most popular answers are. Okay, I'll give you 10 more seconds and then I'll end this poll. Then I can share the results. Okay, 2 seconds. Okay, I'll share the results. So we have 52 people who replied. So first question was, in general, do you think that this is a good time to buy a house? And we had that the majority thinks this is somewhat good time, right? So the 17% who answered a very good time, 58% answered this is a somewhat good time. The second question asked, do you think that home prices will go up or down? And this is a bit mixed. So we have about 1/3 in each group. So about 1/3 thinks that price will go up, 1/3 price will go down, and 1/3 thinks that price will remain the same. Then questions 3 and 4 asked about, do you think that buying a home is a safe investment or risky, and that has potential or not? And so what you see is for buying a home that a large majority thinks it's a relatively safe investment. So about 80% in total, 85% in total answered that it's a safe investment. And then the answers between a lot of potential or very little potential are a bit split. While for stocks, what we see is that most people agree that it has a lot of potential, but it's risky, right? So I think what's really interesting here is that stocks are clearly considered as being more risky than housing. And this is very much in line with earlier research, right? So let me show you a couple of findings from surveys like this, but done on a broader cross-section of the population. So if you ask people, if you ask households, this is evidence for the US, but if you ask households, do you think this is a good time to buy a house? The proportion that answers that it's a relatively good time to buy a house is pretty stable over time. So on average, about 70–80% of households are likely to answer that it's a good time to buy in almost in any given year, or almost irrespective of what the state of the housing market is. If you then ask why is a good time, these motives change a bit over time. So note that this is a period, 2007 till 2017, in which housing prices were decreasing over the first 4 or 5 years and then increasing since 2011, right? I think we see that in many developed economies. The years after 2007 were a bit volatile, and more recently prices have been going up. And so what you see is that if you ask people why is a good time to buy a house, then the reasons that people give change a bit over time. So in the when the housing market is not doing as well, people focus on affordability more. When the housing market is increasing or is doing better and better, then people focus more on the availability of cheap credit or on investment purposes, right? So one thing that comes out of earlier research is that as prices go up, more and more people start considering housing a potential investment, right? Which is interesting because housing is becoming more and more expensive, and yet people think it's a good time to buy because prices will become even more expensive. So as I said, about 70–80% of households typically in such surveys are going to say that housing, that it's a good time to buy a house. Households typically think of the potential of housing and stocks about similarly. But if you, what is really striking, and this came also out of our little survey that we just did, is that typically households say that stocks are risky, just like you did in our survey, while households are much less likely to say the same about housing, right? So housing is considered a much safer investment than stocks, which I think is interesting. There's some other older survey evidence on beliefs and what explains changes in the housing market, the change in price in the housing market. And so there's a famous study that was done in the late 80s, early 90s by Robert Shiller, who's a Nobel laureate in finance or in economics. And he surveyed people in the US and different cities in the US about what is driving price changes, right? Do you think prices will go up or down, and why? And he said that among the 1,000 survey respondents, not a single person cited any evidence about supply and demand. Instead, there's a resort to cliches or reference to evidence that one could see while driving around the city. So he's one of the first ones to point out that the so-called popular models, the beliefs that households have about real estate as an investment, is not always driven by quantitative evidence, but it may be more driven by sentiment and by sort of experiences in the housing market. One part of his survey that I really liked is that he says that one of the most common responses in California to the question about what explains recent changes in housing prices was that the region is a good place to live. But California has always been a good place to live. So households are explaining changes in prices with an unchanging variable. But then I think you often see that in the housing market. You see that in the art market as well, by the way. I do a lot of research on the art market. And when you ask people, why do you think Picasso is a good investment? Then people typically say, well, because Picasso is a great artist. But of course, that Picasso is a great artist explains why Picasso is expensive. That doesn't explain why he should become even more expensive over time, or why the returns to Picasso should be higher than to other artists. And so you see something similar in real estate, that when you ask households about their beliefs about real estate, they often answer questions about price changes with something that is not changing over time. For example, the fact that California is an attractive place to live. The other thing that came out of his survey, and that has been repeated since, is that in many cities, and this was particularly true before the 2007 housing price crisis, there was a feeling that housing prices cannot decline. Respondents in boom cities tended to think that the same sort of price increases seen recently would continue indefinitely. And this is something that in other research more recently has also been evidenced very clearly, right? So typically people think that going forward, price increases will extrapolate from recent events. So if recently prices went up, then people expect that price will continue to go up for a substantial amount of time. So personal experiences, recent trends, what people see themselves is really important in driving people's beliefs about real estate as an investment. There's many different ways to show this. One picture, one graph I really like is this one. So there's a recent paper that looked at households living in different states in the US and then asked them about what are your expectations for how house prices will change over the next year nationwide, right? So not in your state, but nationwide, across the country, over the US, how do you think house prices will change? And if you then link how people think about future house price changes, if you link people's beliefs about future house price changes to their own experience and in their own state, you see that there's a clear relation between the two. For example, in California, where people had experienced large house price increases, people said that they were expecting higher house price changes nationwide than in states like Connecticut, where people were experiencing much lower price increases themselves. Right? So how much house price changes, how the housing market has done where you live, really drives your beliefs about housing markets, about house price changes, even if the question is not just about your state, but is about the country as a whole. And there's many more ways to show this, but there's a lot of recent research that shows that people extrapolate to a very large extent from their own experiences when forming beliefs about real estate going forward. There's other research recently that has also showed that the social dynamics in this are also very important. So there's one very neat paper that actually looks at your Facebook network, your Facebook social network, and shows that whether you're going to buy a home and what your beliefs are about house price changes is driven by where your friends live, where your Facebook friends live. So if you have a lot of Facebook friends in California where house prices are going up quickly, you're also going to be more optimistic about housing price changes, and you're even going to be more likely to buy a home compared to when your friends live in Wyoming or some other US state where housing prices have changed much less. There's other papers that have shown similar types of dynamics, for example, showing that if you observe a lot of investment activity in your neighborhood, then you're also going to be more likely to think of real estate as an investment vehicle. Right? So there are these really important social dynamics that complement your own personal experiences in driving your beliefs about real estate as an investment. Now, I think this is interesting. Like, why do we see these dynamics in beliefs? Why do we see so much cross-sectional time series variation in the beliefs about real estate as an investment? And I think one reason for this is that unlike for stocks, for example, there's still a lot of disagreement about the historical returns and riskiness of real estate. Why is that? I mean, that's a bit strange if you think about it, right? Because think about stocks. there's no disagreement about the performance of the stock market historically. We all know what the S&P 500 has done, or the CAC 40, or some other stock index has done. There's no disagreement about whether stocks have been a good investment or a bad investment. I mean, the data are easily available. Why people still debate what historically the returns to real estate has been, in my view, relates to the fact that there are substantial measurement issues when it comes to estimating the returns to real estate. And I just want to mention the three most important dimensions in which real estate returns are much harder to estimate than, for example, stock returns. The first problem that you don't have with stocks is that researchers have really struggled to control for changes in the quality of housing over time. If you see prices going up, if you see rents going up, that doesn't necessarily mean that prices in a quality control sense are really going up, that the housing is really becoming more expensive. Let me take the analogy of mobile phones, for example. Yes, an iPhone today is much more expensive than your Nokia of 20 years ago, but at the same time, that iPhone can also do much more than your Nokia of 20 years ago. Similarly, if you see that rents are higher today than 20 years ago, 30 years ago, well, that may be true, but maybe you have a better isolated flat, or maybe the quality of the finishing is better. Maybe there's more bathrooms. So there's many dimensions. Maybe there's air conditioning. There's many dimensions in which average price changes may reflect changes in quality rather than true price increases once controlling for the quality of the underlying properties. Right, and this has really been a challenge for a lot of research, right? So how do you compare a house today with a house 50 years ago? The second problem that the research has struggled with is that there's not a lot of data out there on income realized by real estate investors, right? So we have a lot of data on prices, transaction prices, from the notaries or from governments, but there's much less data available that tells us what is the actual income that real estate investors have realized. So how much rental income are they really getting on their investments? The third problem, which is a bit related, is that it's clear that housing necessitates maintenance or repairs, right? So you need to spend money on your property if you want to keep it in shape. However, and this subtracts from your net return. However, we don't have a lot of good data on how high these maintenance expenses really are. Right? So basically, if you think about these three problems together, one of the reasons why the returns to housing are so hard to estimate is that it's hard to control for changes in characteristics of quality over time. We don't always have good data on income, and we don't always have good data on maintenance expenses. And so what I'll do is I'll focus I'll present a research project that tries to mitigate some of these problems. So I'll do that in a few slides. And so I'm really going to focus on this return measurement. At the end, I'm also going to come back to the issue of risk, right? So I think one of the reasons why people disagree whether housing is safe or not is that it's not so clear what the right risk metric is. How do we measure risk when we think about housing? For stocks, it's quite clear. For stocks, we can look at the volatility of the index, the stock market index, for example. However, for housing, it's not so clear that the volatility of an index is really the right metric. Households don't own a portfolio of houses. They typically own one house, maybe two houses. But it's not so clear that the volatility of the aggregate market is as important or relevant for them as a property level or asset level risk measure. So this is something I'm going to come back to at the end. Right? So I'm first going to focus on returns, and at the end, I'll say briefly something about risk. So what do we know about long-run returns on real estate? right? So what have different papers have tried to deal with the different problems I mentioned on the previous slide. So what do we know about long-run returns in real estate markets? So one thing, it's clear that recently returns to housing have been relatively high, right? So in the most recent years, but also the early 2000s, the 90s, in many places, returns to real estate have been relatively high, mainly because prices have gone up quite a bit, right? I think for those of you live in Paris, around Paris, it's very clear prices have been going up quite a bit, and this is true in many places around the world. So recently returns have been high. However, if you look at long run, if you take a really long run perspective on price changes, I think the available evidence also tells us that the long run price changes, once you control for inflation and changes in quality, are probably close to zero, right? Even though price increases recently have been high, if you look at a really long run perspective, that's not so clear anymore. There's many ways in which I could illustrate this, but I thought, given that we're, at least in spirit, we're in Paris today, let me show you this graph that shows a home price index for Paris since 1200. This also illustrates how difficult it is, almost philosophically, to think about housing price changes, right? Of course, a property in 1200 is something very different from a property today. The nice thing, if you look at home prices since 1200, you can see things like the effect of the Great Plague or of wars in the Middle Ages and so on. You can also see the effects of world wars, rent control. So there's a lot of things you can see. But what I want to focus on here is that it seems that, yes, in the really long run, prices go up. But if you compute actually over this 800-year period, if you compute the average price increase per year for Paris, which we all agree today has very high real estate prices, the average increase in prices per year is only 0.6% per year. And I think if you look at other long-run studies for the US, for Europe, most studies will come to the conclusion that in the really long run, the average price increases are probably somewhere between -1 and +1% per year, suggesting that what is really driving real estate returns is going to be the income component, not a price component, but the income or rental yield that investors can get on their investment. And there we have much less evidence, right? There's very little evidence that looks at long-run total returns, so including income, rental income, but also expenses for maintenance and repairs. There's just very little evidence out there. And again, this relates to the measurement problems that I talked about before, which is that it's really hard to get good data on what historically have been the income and expenses associated with investments in real estate. So what I want to do in sort of the remainder of this talk is I want to present new evidence on returns to real estate based on a very recent research project of mine. And so I'm going to focus on the first 80 years of the 20th century, right? We know that in the 80s, 90s, sort of since then, returns have been relatively high. So I'm looking at the first 80 years of the 20th century. You can think of this almost as an out-of-sample test of the returns to real estate. And the empirical setting I'm going to exploit is a bit peculiar. What I'm going to do, or what we do in the research paper, is we look at the property investments, the property holdings of Oxford and Cambridge colleges. Oxford and Cambridge colleges, this is a picture of King's College in Cambridge, have been around for many centuries. And what's interesting about them for us as researchers is that they have been holding real estate for a very long time. Some of this was endowed by the monarchy centuries ago, but also more recently, property has been a really important part of their endowment, of their financial investment holdings. And that's a nice setting for us as researchers, because all the data on their historical property holdings, be it income, costs, or prices, we can retrieve in the archives of these colleges, right? So these colleges have been important real estate investors throughout history. And that's what allows us to go into the archives of these colleges and look at what are the prices they paid, what are the prices at which they resold properties, what is the income that was generated by the properties, what are the maintenance expenses that they incurred on their property holdings, right? So that it's a really nice setting for us as researchers. I mean, even today, I mean, I'm going to look at the period 1901 until 1983. But even today, these colleges are really important property investors, right? So this is from a screenshot from an article from The Guardian of 2018, which revealed that taken together, the Oxford and Cambridge University colleges own about £3.5 billion in property, right? And for example, the O2 Arena in London, which is shown here, at least at the time of writing of this article, was actually owned by a Cambridge college, right? It's a bit crazy if you think about it, but so when I'm talking about properties held by these colleges, I'm not talking about the buildings that they use for teaching or research. I'm really thinking of assets that they hold as an investment. And so the kind of data, and this is a bit different from what most of my colleagues are doing who are working on stock markets or bond markets, but the kind of data we've been using looks like this, right? So we go into the archives, we collect, we make pictures of data of the accounts of the colleges, and then you get very detailed data. So this is, for example, a farm, Middle Cliston. It's a farm in a village in England. And one of the colleges had a property there or owned this farm there. And so you can copy from the accounts, you can copy data on the rents that they received, the costs that they incurred, and then the prices that they paid for the property or received for the property. All right, so that's the kind of data we've been working with. There's much more in the paper, and I'd encourage you to have a look at the paper if you're interested. But just to give you a sense of what these colleges own, so this is one of the 4 colleges we're looking at, namely Trinity College and Cambridge. And so Trinity College, throughout our sample period, it always owned a few hundred of properties. And it was split between residential, which is the focus of today's talk, commercial, agricultural. If you think about income, commercial is much more important than residential. The reason being that an average property, type of commercial property, think about an office building or a shop, generates much more income than the average house, right? So commercial real estate for all of these colleges over the course of the 20th century has become the most important asset category. In the beginning, in 1900, it was mainly farmland. At the end, it was mainly commercial real estate. Okay, so then we do a few tests on these data, right? So we have a couple of hundred or maybe a few thousand properties. We observe prices, we observe income, we observe costs. So this will allow us to do a few things. One of the first things we want to do is we look at what is the historical income growth, right? So controlling for changes in quality. How has income developed over the 20th century? Now, what's interesting, so this shows for the 3 different property types, but again, I want to focus on residential, which is the green dashed line here. If you build an income index that you scale at 1 in 1900, and then you follow the evolution of rents or rental income over time, what you see is that actually rents have not increased once you control for changes in quality characteristics and control for inflation. Right? So over this 80-year period, at the end of this 80-year period, rents were actually lower in real terms at the end of this period compared to the beginning of this period. Right? So it's a bit different for agricultural and commercial, but again, we want to focus on housing here. So housing rents have actually gone down over this period rather than up. Then the other thing I want to show, and this looks a bit like a Damien Hirst spot painting maybe, but what we can do is we can compute yields. Whenever we see a transaction, we can compute what is the gross income yield associated with this transaction. In other words, if we scale income by prices, we do a simple income to price computation. What are the yields associated with property? And again, we can do this for agricultural, commercial, residential. Let's focus on residential. Residential are the green triangles here. I mean, there's a bit of dynamics here, but what I want you to see mainly is that if you compute gross yields, well, in 9 out of 10 cases, they're below 8%. Actually, on average, if you compute the average here, the average gross yield is about 5%, right? So it's even lower in more recent decades, right? So the gross yields on housing are about 5%. You can think of this gross yield as the return that you get that is purely driven by income. So that's not enormous, right? Because this is before expenses. You get about 5%, ignoring capital or price appreciation. You get about 5% before expenses. Now, what then about expenses? So what we also do is we observe costs and income. So we can actually compute how high are costs relative to income, right? So we aggregate costs in any given year, we aggregate income, and then we're going to look how high are costs for these colleges in every year compared to the overall income that they get. And again, there's a bit of time series variation, and I'm not going to go into the details about what drives these dynamics over time. But what you see here is that for residential real estate, which are the green triangles again, that costs are about 1/3 of income, right? And this is similar to more recent estimates based on contemporary data. So you should probably think of maintenance costs to account for about 30-40% of your income, meaning that your gross yield will be lowered by about 1/3 for you to compute your net yield. Again, there's much more in the paper, but at the end of the day, we can use all this data, this historical data, to compute a long-run return on housing. And what we find is that it's relatively low in real terms. So again, this is correcting for inflation. We find a slightly negative annualized capital gain over this period, meaning that in real terms, prices of properties have slightly gone down between 1900 and 1980. We find a net income yield of about 3% on average. And if you combine the two together, you get an average annual net total real return of about 2.3%. This estimate is, of course, for the first 8 decades of the 20th century, right? So more recently, the returns have been higher, but this also suggests that the more recent returns may not be entirely representative for the returns to real estate overall. It's also, I mean, and again, this is not the focus of today's webinar, but we document slightly higher returns for other types of real estate. So farmland, for example, or commercial real estate, right? So it seems that housing has underperformed as an asset class, agricultural real estate, or commercial real estate. So this is all about returns. I told you I want to say one word maybe about risk. So I think one thing that has historically has not received a lot of attention or not received sufficient attention is the fact that people only own one house, and therefore they're very much exposed to what is sometimes called idiosyncratic risk or asset-specific risk. If you only own one property, then that property may do better or worse than other properties, right? So the index for the country as a whole, for example, the housing market index for France or the UK or wherever you live, that will only be a noisy approximation for your own experience, right? You may live in a city where housing prices go up or down more than the average. So that's one source of additional risk that is not captured by a nationwide price index. The other source of risk, idiosyncratic risk, is that whenever you buy or whenever you resell, your price at which you buy or the price at which you resell may be lower or higher than the current market value or the current expected value. Right? So this is sometimes called transaction-specific risk. But whenever you trade, and this is the same for the art market, it's the same for private equity, whenever you trade, you may be lucky or not. And again, this is a source of risk that you cannot diversify away because you're only going to trade one house. Finally, another source of property level risk is that if you look at income streams aggregated over all properties, this is quite stable over time. However, if you're going to look at income streams at the property level, what we show in our paper is that these are quite volatile over time. So property level net income streams are quite volatile. So this chart shows you for every year between 1901 and 1983, what is the frequency or the proportion of properties that see a drop in income of more than 10%. There's a dark red. The dark green shows you an increase in net income of more than 10%. And then the other colors are in between, right? But you see that about 20% of all properties in any given year show a drop in net income of more than 10%, right? So if you have a portfolio of housing for the Cambridge colleges, this doesn't matter too much because they have a portfolio of housing. But if you have only one property, as an investment, your property level income stream may actually be quite volatile. This is true even if you live in the property, right? So you can think of if you live in the property, if this is owner occupied, still you're going to have these maintenance expenses that pop up from time to time and that are going to make your actual income stream quite volatile. Okay, so just to wrap up, so real estate is the most important investment for most households. For any homeowner typically. I think in terms of beliefs, what I wanted to say is that return beliefs are driven by recent experiences in the housing market, your own observations, also social dynamics. Real estate on average is considered a relatively safe asset. I think we saw that in our survey, but that's backed up by more general survey evidence from the US. If you look at the long run average returns on housing, it's probably much lower than that on stocks. So I showed you some numbers, but these return numbers that I showed are low compared to the returns on stocks. And I think we shouldn't forget that housing is relatively risky because of the idiosyncratic risk, because of the fact that you only own one house, and that property may increase or decrease in value. The income stream may be volatile. So most people don't own a portfolio of housing. Most people only own one house. And that's what makes housing risky. In particular, because most households have leverage, right? So they have a leveraged bet because of their mortgages. They have a leveraged bet on one house. And that's, I think, what makes housing a risky investment for most households. Okay, so this is what I had to say. I think there's maybe a few questions. I haven't looked at the questions yet. So Anne, you have to inform me.
I will tell you about the question. There are a number of questions. I'll try to cover most of them, to group them so that we make the most of your time. There were questions about real estate, office real estate. So you talked about commercial, like private and so on. Do you want to say something about office real estate?
It's a very hot topic. That's something I can say. In particular with nobody really knows at this stage what's going to happen to offices after this pandemic is finally over. I mean, there's some research that looks at sort of the future of commercial real estate market, the future offices. I'm reluctant to make sort of big claims about this. I think what I can say is that historically, I mean, if you look at the last 50 years or so, probably the office market has been quite a decent investment, probably better than housing. It's clear that currently there's a lot of uncertainty, right? So nobody knows how much working from home would really be completely implemented in a day-to-day work routine. I mean, you see a lot of big companies, technology companies that say we're going to get rid of offices entirely. And indeed, that raises questions then about how are we going to repurpose those offices. So I think it's a very interesting market. I don't have much to say about it because I'm as much curious to see what's going to happen than you are.
Right. Definitely a topic that we'll hear about in the coming years, I'm pretty sure. There was also a question about the sharing economy in real estate. So, all the Airbnb and similar trends, similar players that we've seen appearing on the market.
So I think, okay, so it's definitely, it's a hot topic. Also for researchers, right? It's not obvious lots of people are worried about the effects of Airbnb on affordability of housing. Now, that of course depends a lot on the regulatory framework, which differs quite a bit from location to location. It's also not obvious really to quantify this, right? Because Airbnb comes in areas that are attractive, are becoming more attractive. So correlation is not always causation. But I think overall, of course, there's worries in many places that Airbnb in particular, if they're if they're given some flexibility, are pricing out local residents. I think, next to prices, of course, I think we really should think about welfare effects more broadly when we think about Airbnb as to sort of what is the impact on the quality of life in a neighborhood as well, right? So I think it's one thing that Airbnb is pushing up prices, which is probably true, but these effects may be relatively small if you think about the bigger picture. I think at least as important is to think about what is the effect of Airbnb on the quality of life, right? So this maybe give the opposite effect on prices, right? If Airbnb is coming in a neighborhood and then life in that neighborhood becomes worse, then prices may go down, but that's not what we really want, right? We want to protect the quality of life. So I think these are very important topics. They're not easy because it's super multidimensional, because you also have to think about, of course, for some of the owners in such neighborhoods, this is a source of income. This is a source of wealth, right? So that's also a dimension to take into account. You cannot say that price increases are necessarily bad. There's a lot of local homeowners that are then realizing positive capital gains. So there's a lot of dimensions there, and I think it's very important to think about it a bit more. In terms of the sharing economy, there's other people that have looked at the effects of Uber and shared transportation as well, right? So historically, it's been shown that in places like London, New York, where you live, whether that's close to a subway, for example, or not, that really matters a lot for housing prices, right? Because people want to commute. I guess the same is true in Paris, although in Paris, all the stations are relatively close to each other. But so nowadays, with the arrival of Uber, and maybe that becomes less important. And so there's also people that look at how the arrival of Uber is changing the structure of prices within cities. So I think these are very interesting developments, right? And people, there's academics that do research on this. It's not something I can summarize in like a minute, but I think these are clearly very important topics. I think the thing I would like to say, sort of as a general advice or guideline, is that often these are very complicated questions, right? Because there's homeowners versus renters. You have to weigh off the benefits of, for example, the people who use Airbnb or Uber to the costs of people that are maybe not involved in the transaction. So these are very complicated questions.
Right. Thank you, Christophe. Maybe I'll take one last short question to wrap up, going back a little bit to residential real estate. We've gotten through lots of changes, obviously, this year. And one participant, Bogdan, was asking, what is the impact of working from home on residential real estate? And do companies transfer part of cost to employees in this way?
Well, I'm as unlike my background is suggesting I'm working from home. I'm not at HEC. Okay, so I think all this research is still relatively new. I think there are some research findings for the US that do find that it's changing the price structure within cities, right? So historically, if you think about a place like New York, for example, you have the business center or you have the center of the city, prices are super high. And then the more you spread out or you go out of the city, the lower prices become, right? So you have this sort of slope, if you wish. It seems that this is changing a bit, right? That the slope is getting less steep, right? Because if people can work like 50 kilometers, 100 kilometers from where their employer is based, then of course, prices may decrease. I mean, you may have less reasons to live in the city center of Manhattan or of Paris, and you have more reasons to live a bit outside of the city. And so I think one interesting thing to follow over the next few months and years is to see whether indeed you'll see sort of an equalizing of prices inside and outside of city centers as people decide that it may be possible for them to live actually a bit outside of Paris or outside of London because they only have to go into the office 2-3 days a week, let's say, or maybe 1 day a week. So I think that's clearly something that is interesting. It may decrease prices in the city center and increase a bit outside of city centers, in particular if offices are going to become available, right? If in city centers you'll have offices that can now be repurposed into flats, then of course this would only amplify this trend that in cities maybe we'll see sort of more supply than we've seen in recent years, or increases in supply. Think about Paris. Paris is very famous for being super supply restricted, right? The area within the ring road is quite small and there's not a lot of scope for building. But of course, if you already would see some people that are happy to live a bit outside of the city, maybe some offices relocating or no longer being in use, maybe that could change the dynamics of prices a bit. Again, I think the pandemic is changing so many things in our lives, and I think real estate markets are just one dimension of that, but clearly things are going to change.
Thank you very much, Christophe, for this. Can I ask you one last question?
Of course.
Because at the end of the day, I'm a marketer, so for me, I understand all the part on investment that has to do with very rational financial elements. And we didn't talk too much about the hedonics of it, the emotional part and benefits of home ownership. Do you want to, beside the good investment financially, is there something emotional that is important to take into account as well in people's choices?
Well, when I talk about, I have some research on art investments, and when I talk about art investments, I typically say, well, financially it's a bit tricky, but there may still be a lot of non-financial benefits or utility, if you wish, from owning art. I think it's somewhat similar for housing, right? So, and I think the non-financial benefits of home ownership, they're also a bit under-researched. There's sort of the obvious things, like some people get a lot of pleasure or a good feeling from owning a house, of building a home. There's some recent research that also suggests that there may be other more subtle effects. Financially, for example, some people claim that if you own a house, you have to do the mortgage payments, that this is a commitment device for you. You're going to consume less, save more, because in a way you're forced to save because you have to do your mortgage payments. But there may be other non-financial benefits, right? So there's some research that suggests that homeowners are more likely to start a family or have a bigger family because, right, you have a home and you feel that you're creating a safe environment to have children, for example. or there may be other effects on your children, right? There's some research that suggests that intergenerationally, there may be positive effects from growing up in a home or having a stable environment, maybe a good I mean, there's research on the importance of neighborhoods as well. So it's true that there's definitely and I would say that non-financially speaking, there's probably more benefits than costs, right? So I think when anybody is making the decision whether to buy or to rent, the non-financial benefits should be taken into account. I mean, there's also non-financial costs, right? It may be harder to move, harder to change jobs, but I mean, there's a lot of non-financial benefits, and these should definitely be taken into account. I think in that sense, it's a bit like art, right? So I'm not saying that housing is a bad investment. It can be a very rational, can be an optimal investment, as long as you're starting from the right information, as long as you're starting from the right data. I would never recommend anyone to buy a house purely for the financial dimensions, right? Because it's risky, you're going to take a levered bet, right? There's all these things that we talked about today. But that doesn't mean that it cannot be a rational investment, right? Because there's all these other side benefits, if you wish, as well. If you get a lot of utility or pleasure from living in your own house, then by all means, go for it. That's what I'm doing, but after all, so.
Thank you very much, Christophe. I guess this is the time. So thank you for your involvement today. We learned a lot, so that was very interesting. And thank you to all our participants for your participation, questions, and interest. And I wish to see you again next month for our next webinar. So stay tuned with HEC. Thank you again and have a nice day.